Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video I want to talk about some tips on getting your trades filled a little faster. So for me, generally this whole concept of order entry or placing trades is really the most important aspect of options trading. Enter the wrong position, the wrong strategy, or the wrong pricing, and really no amount of adjusting or hedging will save you. That's why we spend so much time here in track number 2 on entering the right trade and getting trades filled. So today I want to cover 8 tips on how to get your trades filled either faster or at better pricing than you are now. So the first tip is actually patience. And the reason that I put this first is because I feel like a lot of people in this business, whether you get started or whether you're an experienced trader, always have a lack of patience. And I do too. And patience is a hard thing to do. You want to get trades in, you see good pricing, you want to have your order executed and filled, but sometimes patience can be the most important thing. And what I've learned over the last 8 years doing this is that there's always another trade or an opportunity or a setup or whatever. Meaning that there's always going to be another chance to either get in or another trading opportunity. So it's never worth forcing a trade into the market for the sake of trading. Number 2 is try odd lots. So instead of placing an order at say 10 contracts, which is like a round lot number, try 9 contracts instead. We usually find that this, works well if you try placing 10 contracts, try placing an order for 9 contracts, and then if that gets filled, place the other order for 1 more, or place an order for 4 contracts or 6 or 7. So try something a little bit different than just say like 1 or 2 or 5 or 10 or 15, etc. So try some of these odd lots. Again, this is going to be a little bit different. So one of the techniques that you can use, again, just trying this odd lot mentality. And again, just one little point here before I continue forward, is this is why, at least on my end, I prefer to work with a broker that charges me on a per contract basis instead of a per order basis. So everything that we do here at Option Alpha, or at least in my personal account, is on a per contract basis. So the commission would be the same whether I did 2 orders of 5 contracts or 5 orders of 1 contract. It doesn't really, matter. So that's just a little side note there. Number 3 is try legging into a strategy. So for example, if you're trading an iron condor, try entering each credit spread side independently. So enter the put credit spread side and then try to enter the call credit spread side. I can tell you that this is not necessarily the preferred thing that you can do. It's just a strategy that you can use to fill orders. I generally like to fill both sides at one time, but for example, with an iron condor, it can be a little hard to fill 4 individual options, then all of the different pricing that has to match up and all of the number of contracts with somebody else. So it can work in some instances to try to fill each side independently. I don't ever really, prefer to do independent legs within that. So I'll do like a credit spread side, but I won't actually go out and do each individual leg. So I won't buy some calls, then go in and sell some calls, then go in and buy some puts, and then sell some puts. I won't do 4 particular orders, but I'll try to spread the trade out into its breakdown pieces. So credit spreads or debit spreads, something like that. Okay, so try legging into a strategy. Number 4 is use round number pricing. Now this can actually work in both directions, meaning that if you see a trade that's trading around $1.50, try entering the order around $1.49 or $1.51. Likewise, if you see a trade that's trading around $1.51 or $1.49, try entering the trade at $1.50. So try using some of that round lot pricing or round number pricing. Might help get the trade filled a little bit faster. And again, this can work in both directions, so you just have to kind of play with it. I always try to, kind of stretch the market a little bit. Number 5 is know your mark. Never enter a trade at the bid or the ask price. Know where the last trade was executed. And we have training on this here at Option Alpha. You can just search the bid-ask spread or the mark. But basically what you want to do is make sure that you're trading first in really liquid underlyings, which we talk about here in track 2 and in track 1. But you first make sure you're trading really liquid underlyings. But then number 2 is make sure that you know where the last market price or the last price that was traded. So for example, if you're looking at a stock and the bid and the ask spread was 115 to 120, that means that the last price may have been 116 or 117, somewhere in between the bid and the ask spread. So just know where that mark is. It'll help reduce some of the slippage that you might otherwise have missed entering some trades. Number 6 is stretch the market. So I always try to offer either above or below, depending on which way we're trading, the market prices to see if there are any takers. And again, you don't know if there's anybody out there that's looking for that position at a different price. So for example, if we're getting into, let's say, a trade where we're selling options and taking in a credit, I might try to offer a couple pennies or a couple dollars above where the market is trading at the moment. So if let's say we're selling a strangle and the strangle is priced at $100, I might try to get that strangle in for $105 or $104. I'm not going to really stretch, really wild prices. Like I'm not going to try to get it filled at 150 when it's trading at 100, right? It's not going to happen. But I will try to stretch just a little bit just to get maybe a couple dollars out of the market, see if there's any takers. Sometimes it works, sometimes it doesn't, but I always try to stretch. That also means if we're going to buy options, so let's say we're going to buy a debit spread and it's trading at $50, I might try to buy that debit spread for $48 or for $47. So I'll try to stretch a little bit, try to offer a little bit less than what the market is. Maybe there's somebody who's willing to come down and meet me at that price and get the trade filled. Number 7 is adjust slowly. It is okay to adjust prices to fill. I get this question a lot with our Pro and Elite members when people get started. Is they say, well, I placed the order and I don't know if it's okay to adjust or move my prices. Yes, it's always okay to adjust your prices to fill. You just have to do it slowly and don't rush. Remember, order entry is really, really important. You want to make sure you're getting fair pricing, as we talked about before. You want to make sure that you're getting decent pricing on spreads that kind of correlate with the risk in the trade. So don't rush this process. Usually what I do is I wait, anywhere between 10 and 15 minutes. It's not like a hard rule where I've got a timer for 15 minutes, but basically I'll place an order. I'll let the market kind of trade around that order. I'll come back, and if it hasn't filled after 15 minutes, then I'll kind of reassess the trade. So did the market move higher? So do I need to move my prices? Do I need to adjust my strike prices, to maintain that probability of success that we were targeting? So I think you have to really do it on a slow basis, because if the market does move, and it can move pretty fast, as we all know, then you want to make sure that you're still, calculating everything out appropriately so that you know exactly what you're getting into. So again, don't rush, but it is okay to adjust, just do it slowly. And number 8 is follow the volume. So see where the volume is today and look to possibly adjust your strike prices. I think this is a really key concept, but if you trade after the market opens and you let some of the volume come in and let the market kind of work out for a little bit in the morning, and usually I do my trading somewhere around 30 minutes after the market opens. I don't like to do a lot of trading when the market opens right away, and I want to see where the volume is. So like, where's the activity today? So if you look at a particular strike price and you see that, let's say the 110 call options have a couple contracts that are traded, the 111s have a couple, but then the 112s have like 500 contracts that were traded. Well, that might be the place where people are focusing their attention, is those 112 call options. So you might need to look at adjusting your strike prices. Maybe you were targeting the 110s or the 111s. Maybe you can take a little bit less money and target the 112s, because you might get filled quicker and you might get filled at a better price instead of waiting for somebody to, fill at the 110s or the 111s. So always see where the volume is. You'll definitely see there's noticeable spikes in volume, at particular strike prices. It's usually around round or even lot strike prices, so like 85, 80, 75, etc. You'll never really see a lot of volume in kind of those uneven strike prices typically across the board. So there may be some outliers there, but usually if you have strike prices of $1 wide, you'll see most of the volume at like those $5 increments versus like those $1.50 increments. Okay, so that's another quick tip for how you can get orders filled maybe a little bit faster. So as always, hope you guys enjoyed these videos. If you have any comments or questions, please ask them right below. If you love this video, please share it online. Help spread the word about what we're trying to do here at Option Alpha. And until next time, happy trading.